market that keeps hitting new highs begs the question how and when this longest economic expansion on record will eventually come to an end. At the moment, we have a lot of good things happening in the marketplace. We got interest rate cuts by the Federal Reserves. In 2019, they cut rates by 0.75%. They are very accommodative to the US economy. There is some progress happening with the US-China trade deal. Capital spending, which is down, is trying to recover. And we have an inflow of about $35 billion recently that came into stock funds. And I suspect one of the reasons for that is because people are loading up on the stock market of fear of missing the rally. So that should make us all a little bit more pessimistic and apprehensive about the market. Bull markets always like to climb a wall of worry, and we need to find that worry in the marketplace, such as the worry we had really in the past 10 years, right after the last market collapse. We had worries in the form of European debt crisis back in 2010. Then we had devaluation of the Chinese yuan in 2015. Then we had a rate hike in 2018. And most recently, we had an inverted yield curve, which is maybe the best indicator of a recession. These are the type of worries we should see in the marketplace for markets to keep going up. And my fear right now is that markets are discounting too much of the good news. Leading economic indicators, for example, are growing only 0.3% year over year. That's a lot less than what we used to see. GDP in the fourth quarter is going to come in at about 0.4% growth rate year over year. And that is not the 2s and the 3s and the 4s we got used to see back in 2018. Also, capital spending, which is a very big indicator for economic expansion, is coming down. In fact, it's down about 1%. And if we look at how many new jobs are opening up, we see 7 million, which is great, but it's a lot lower than the previous quarter. Therefore, we need to be still cautiously optimistic about the market. We need to look for companies with very strong balance sheet, companies that pay dividends, companies that don't sell at high multiples. But in general, what I want us to understand is that eventually this longest economic expansion on record will come to an end. One company I wanted to talk about this week is Charles Schwab. I cannot not talk about it because they just this morning announced a merger agreement with TD Ameritrade. And they are buying TD Ameritrade for $26 billion. Based on Charles Schwab's stock in the marketplace, the deal is valued at about $28 billion because TD Ameritrade shareholders are going to get a little bit over 1 share for every share that they have in Schwab shares. We're going to have a mammoth bank here with $5 trillion in assets. The headquarters of Charles Schwab are going to move to Westlake, Texas. They'll still have a major hub in San Francisco, and they will get over 12 million brokerage accounts from that merger and additional $1.3 trillion in assets. In fact, this merger will double the brokerage account numbers that Schwab has. Some people might say it's a result of the last action we saw coming from Schwab when they cut the commission fees, transaction fees for all stock trades and index trading funds. By doing that, some people might say they forced TD Ameritrade to be bought over by Schwab, which might be an antitrust issue. But nevertheless, this deal is coming through now. Schwab added, as a result of them cutting commissions to zero on stock trading and ETF index trading, they were able to bring in over 360,000 new brokerage accounts in only one quarter, last quarter. The number of registered investment advisors that will be now on the Schwab platform will grow to north of 14,500 of them. TD Ameritrade brought in, by agreeing to merge with Schwab, about 7,000 RIA accounts. And by far, they will become the 900-pound gorilla in that space because the next biggest registered investment advisory platform is Fidelity with only 3,000. Net income is expected to go up by 2021 to $6.2 billion. Cost cutting is estimated on the TD Ameritrade platform to be north of $1.4 billion. So all in all, it looks like a very attractive merger. The stock is not that cheap, selling at 18 times earnings. They still have major antitrust issues to deal with. In their favor, I would say that as big as Schwab is, it represents not the biggest company by no means in the industry, because the brokerage industry has $34 trillion in assets, and now Schwab will have only $5 trillion in assets, and that represents only about 20% of the entire industry.
So I just wanted to talk really briefly about Disney. Some news that came out over the weekend. Frozen 2 came out on Friday. This is the sequel to the first film, Frozen 1. And they actually debuted at $127 million in domestic ticket sales and $350 million in global ticket sales. This is actually the biggest opening ever in terms of ticket sales for an animated film. To compare to the first movie had a $94 million debut, and they eventually hit $1.3 billion. The market actually had a relatively tepid reaction on Friday. Disney was only up about 0.5%, the same as the S&P 500 during that same trading session. And I think it's because investors are obviously more focused on the streaming segment of their business. And as we all know, Disney announced earlier this month that within the first 24 hours of the release of their platform, they had over 10 million signups. I mean, of course, we're still unaware of how many of those are paying subscribers, but I think the figure is impressive nonetheless. What I did want to bring up though, there's a series that they released, the Star Wars Mandalorian series, but there's this character, Baby Yoda they're calling him, that's become like this viral sensation. I don't have any empirical numbers to, how many times it's been shared on Twitter or stuff like that, but it's a huge meme, and I think that's actually going to be a huge driver in their toy sales, especially as we inch closer towards the holiday season. CNBC announced last week that Baby Yoda apparel and accessories will soon be available through a variety of retailers: Amazon, Zazzle, Target, Kohl's, Macy's, Hot Topic, as well as their direct channels, Disney Store, Shop Disney, and in their actual parks. I think there are already 2 shirts available on Amazon, one for $23 and one for $26. I think it's amazing how Disney has established such a diverse revenue stream. I mean, they have so many different segments of their business. They have the media, parks and resorts, they have consumer products. I mean, media, for example, I think that's what they're best known for, I would say, is only represents half of their revenue.
I want to talk a little bit about a report that I saw in the Wall Street Journal this morning called the Management Top 250. And it's very interesting when you look at how they rank all these companies. Some of the criteria they're using was customer satisfaction, employee engagement, innovation, social responsibility, financial strength. If you look at the top 10 companies, 8 out of the top 10 are in the technology area. And in the top 50 companies, 16 out of 50 are technology companies. If you look at just technology as a sector, and you take it away from the gains in the marketplace, you got to say that most of the market gains came out of the technology area. And what's driving all of this is the speed of chips, the need for more data, the need for higher clock rates, integration of software and hardware. And as we all know, that software always follows the hardware development, and it usually comes 12 to 18 months after that. So what are some of the driving forces that I see are making all of this happen? Artificial intelligence, Internet of Things, 5G, artificial reality, driverless cars, big data mining, banking, and farming. Now, why would you say farming? They're talking about putting driverless tractors with GPS units out there to plow the fields. So what you do is you increase your productivity, because now you can do it 24 hours a day.
I want to talk about 2 companies today that are affected by a major government contract that has been in the news. In October, the Jedi Contract was announced that it would be awarded to Microsoft, which was highly upsetting to Amazon, largely because this was considered earmarked for Amazon. So what is Jedi? Jedi, or the Joint Enterprise Defense Infrastructure, and it's an initiative for the U.S. government to move its sensitive data to the cloud. Why is this important to our investments? Well, this contract holds a $10 billion price tag. So with something that high, even for companies as big as Microsoft and Amazon, this is highly interesting to them. Amazon Web Services cloud revenue was reported at $9 billion for Q3. In perspective of this $10 billion contract, fairly large. This missed their current estimate of $9.1 billion, and the actual stock tumbled based on that. And on the other hand, Microsoft's Azure revenue up from $11 billion reported in Q2. Their stock actually soared based on these numbers. It was not an apples to apples comparison, since Azure has components that they sell beyond just what their cloud service offering is, whereas Amazon Web Services is all encapsulated in that web service infrastructure. But it's still indicative of how important this contract is. Amazon is actually contesting the award of the contract to Microsoft because they think they are much better suited for it. They hold the Impact 6 certification higher than what Microsoft currently has, which is one of the highest in the industry. Largely, they think it's bias from the president and some of the differences that the CEO, Jeff Bezos, has currently with the president. We're watching this development closely as it highly affects both of these companies.
Today for financial planning, we're going to be talking about ways to save for college. So this is something that's important to any client that has kids. They're thinking about how are we going to pay for college? What's the best way to do that? And some of the facts are that 19% of borrowers owe more than $50,000 upon graduating. So children born today could end up paying 4 times more than the current price of tuition if inflation keeps up. That being said, only 36% of middle-income families and 29% of low-income families are putting money away for the kids' college education. So some of the different vehicles, investment vehicles, and ways that you can save for retirement. The most popular one is probably the 529 plan. That's kind of the one that you hear a lot about. These plans are offered at the state level, so 30 different states offer these kind of plans. You can actually use a plan from a different state if you want to. The money is invested after tax, and if it's used to pay for qualified education expenses such as tuition, books, room and board, you're able to take that money out tax-free to go towards those qualified education expenses. The major downside with this plan, though, actually is that if your child ends up not going to college or something like that, if you want to go take that money out, you actually have to pay income tax on the full distribution as well as a 10% penalty. So this is actually a major drawback to the 529, even though it's one of the most popular options. The fact that there's very little flexibility can end up being a major issue down the line. Another popular option is the Roth IRA. So even though this is a vehicle that's designed for your own retirement, you can use those funds to pay for college as well. And again, if it's for qualified education purposes, you can take that money out without paying extra tax on it. Again, this is after-tax money you put in, you take it out in an after-tax manner as well. So the other one that we like a lot here is the custodial account. So this would be an account where if your child doesn't go to college, it's okay. There's no big drawback in terms of getting the money out. Yes, you have to pay some tax along the way, and the money does go to the child once they turn anywhere between 18 to 25, depending on how you set it up. That money, it is owned by the child at all times, and by the time they turn 21 or 25, that money is theirs to use however they want. So the big risk there is that you have to trust your kids a little bit to use the money and invest it responsibly, however they end up using it. The other option is just a regular brokerage account, a trust account. This is just a normal account that you set up in your own name. Full flexibility, use it however you want. Once your kid goes to college, you can take the money out and put it towards tuition. This is really the most flexible. It doesn't matter how much you trust your kids because you control what you do with that money.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. As always, if you like the content, become a subscriber to our YouTube channel. You can also call us directly to our main offices in Woodland Hills at 818-914-7461. The highlight of the week is that during the longest economic expansion on record that we are experiencing right now, investors will also be mindful of slowing leading economic indicators and capital spending. Look at your portfolios and make sure that you are well diversified for the future.